Hello everyone, welcome back. In today's video, we are going to solve plate and saucer company question. So this question is again from the topic consolidation, and this is a multitask question, which means that here we will have various requirements. Fine. So let's get started. So we have two entities, plate and saucer, and their year end is 31 December 20x4. So note this year end because it's very crucial. So we have been given the statement of profit and loss, revenue, cost of sales, profit, operating profit, and finally the profit, right? And then we are given few notes. So let's see what is the first requirement. Okay, so we have to prepare the consolidated statement of profit and loss for the plate group. Okay, let's see. So, Plate acquired 70% of equity shares in Saucer on 1st January 20x1. So, our current year end is 31 December 20x4, right? This is the current year end, and the company was acquired on 1st January 20x1, which means that we are going to consolidate for the entire year. Okay, there is no mid-year acquisition, so we are going to consolidate for the entire year. Okay, let's read further. During the year ended 31 December 20x4, Saucer sold goods to Plate for 1,50,000, making a markup on cost of 20%. Fine. 1/5 of these goods remained in inventory of Plate for the year end. Right. So this will give rise to PURP, and we will adjust it in our cost of sales. Okay. So let's get started. First, we have to find the revenue figure. Okay. We have to find the revenue figure. So see, we are simply going to add this 1500 and this 700, and from this we are going to eliminate intra-group trading. So see, I'll write over here, there was a parent company and a subsidiary company. P is the parent company and Saucer is the subsidiary company. Okay, so P has acquired 70% of Saucer company. Now we are given a case where S has sold good to parent company, which means it is an upstream transaction. Okay, S has sold goods to P. So the revenue which has been recorded is at 1,50,000. Okay, goods were sold at 1,50,000. So this P and S are a part of one group only. Okay, they are part of one group only because P company has acquired S company. So the sales which S company has made to P company are intra-group sales. Okay, since they are part of one group only, we have to eliminate this intra-group sales of 1,50,000. Okay, so from here I'm going to deduct 150. Okay, I have ignored 3 zeros because they are dealing in 3 zeros. Okay, so that's why I have over here ignored these 3 zeros. So I'll add 1500, I'll add 700, and from that I'll deduct 150. Okay, so that would give me my answer of 2050. Okay, over here I'll write 2050, right? Now next is cost of sales. So see, over here in cost of sales, I'm first going to add 775 and 370, and then again I'm going to eliminate this 150 because these are the intra-group sales. But now I have to make an adjustment for our unrealized profit too. So see what's given over here. They said that goods were sold on a markup, okay, on a markup of 20% of cost. So let us assume, let the cost be X, okay, the cost of goods were X and we have sold on a markup of 20%. Okay, markup is always on the cost. So our cost is X. So take 20% of X, which will be equal to 1,50,000. Fine. Like this. Okay. So I'm now going to find X, which would be X is equals to 1,50,000 into 5 upon 6. Okay, you can do the cutting over here, 1 by 5. So I have taken 5 over here and then I took the LCM. Okay, this is just the basic maths. Okay, I'll show you once again over here how I have done so that there is no confusion. So I took the LCM 5. So 5x plus x is equals to 1,50,000. So x is equals to 1,50,000 into 5 upon 5x plus 6. 5x plus x would be 6, so I took 6 over here, right? So that's how I have done this. So let us find the cost. 1,50,000 into 5 divided by 6. So my cost is coming out to be 1,25,000. Alright, now see, the selling price, the goods were sold for 1,50,000, but their cost is 1,25,000. Okay, so the profit would be their difference. They have been sold at a higher price, but their cost was 1,25,000. So the difference is the profit, which is 25,000. Okay, so this is the profit as of now, which S company has made. So they have told us that 1/5 of these goods remain in inventory of plate company, which means that this is a group in which there is one plate company and next is the saucer company. Okay, so saucer has sold goods to P and P is still holding 1/5 of these goods, which means that P has not sold 1/5 of the goods outside the group. Okay, which means that there is an unrealized profit on these 1/5 of goods because these goods have not been sold outside the entity. So my unrealized profit would be 1/5 of 25,000, which is 5,000. Okay, so in my cost of sales, I'm going to add it. Okay, why am I adding? In order to increase the cost. Okay, so in order to increase the cost, I will add the unrealized profit. So again, ignore the 3 zeros because we are dealing with 3 zeros. Okay, everything has been given in 3 zeros over here. So what I'm going to do, I'm going to add 5 over here, right? So let's see what would be the answer upon calculating this. So this would come out to be 1,000, right? And we are going to subtract it because these are cost of sales. So subtract 1,000. And when you will make this adjustment, you will get the gross profit of 1,050, right? Now next let's see administrative expenses. So there is no adjustment for administrative expenses. We have been given an adjustment for interest. So we will deal with it later on. So for administrative expenses, just simply add 317 and 135. Okay. So when you will add 317 and 135, you will get a figure of 452. Okay. And since it is an expense, we are going to subtract it. Okay. So when you will subtract 452 from 1050, you will get operating profit of 598. Right? Now let's move forward to interest receivable. So first of all, I'm going to add both these figures. Plate company has to receive interest of 15. Okay, and saucer company will receive interest of 0. Nothing is given over here, right? Now let's see. We were given an adjustment. We'll see what is it saying. On 1 October, On 1 October 20x4, Plate made 1 million loan to Saucer. Interest is charged at 6% annually in arrears. So this is our year, okay? This is the year end, 30 December, 31 December, okay? And the loan was made on 1 October, okay? Over here, 1 October, we made a loan of 1 million. So Plate has made this loan to Saucer. So in books of plate company, there would be an interest receivable because if plate company has made loan to saucer company, so plate company would receive interest on that loan, right? So let's see what would be the amount of interest. So take 1 million 6% because that's the interest charge, which is 6%, and we will do proportionate because from October to December, see how many months are there? October, November, December. So for 3 months, we are going to find the amount of loan. Okay, so do the necessary adjustments and you will find that this is coming out to be, let me calculate it, 1 million 6%. Okay, for 3 by 12. So this is coming out to be 15,000. Okay, so we need to eliminate this because we have just studied that P and S are part of one group only. Okay, so this P2S loan is an intra-group loan only. Okay, this is happening between the same group. So we will eliminate this interest receivable. Okay, so again, I'm going to ignore these three zeros. So 15 plus 0, and from this subtract 15, which is the intra-group interest receivable. Okay, so my answer will come out to be 0. Okay. So over here in interest receivable, write 0, and we are going to add this because this is an income. Okay, interest receivable is an income, so we will add it. Right, now let's see for finance cost. So take 60, add 20 to this, and now see, if parent is making loan to subsidiary, so in books of parent company it would be interest receivable. Okay, and in books of subsidiary company it would be interest payable. Okay, because it has to pay interest, or I can say this is a finance cost for the subsidiary company, right? So we are going to eliminate this similar like the way we did over here. Okay, we deducted 15 from here, so similarly deduct 15 from here, because interest receivable for one is interest payable for another. Okay, so add 60 plus 20, and from that deduct 15, so you are going to get 65 as your answer. 65 would be the answer, and we are going to subtract it, right? Let's move forward. You can calculate profit before taxation from here. Now we have to tell income tax expense. So for income tax expense, take 96 and add 45 to this, okay? And you will get the answer of 141. And again, because this is an expense, we are going to subtract it, okay? So see over here for item number 1, we have to choose from here. So let's see. We will add, these were the figures, right? We will add 775, then 370. From that we will deduct 150 and 5. Add 5. So let's see which option is this. 775 plus 370. Yeah. Minus 150, which are the intra-group sales, and plus 5, which is the unrealized profit. Okay, we have to choose from here. So we will choose the second answer. Okay, for finance cost, we saw that we added 60 and 20. Okay, and from that we deducted 6% of 1000 for 3 by 12, which is option number 3. So this one, right? Now we have to calculate NCI, non-controlling interest. Okay, so see over here, this is our parent. Yeah, this is the subsidiary company. So parent owns 70% of this. Okay, so the remaining 30% is controlled by the outsiders, whom we call it as NCI, non-controlling interest, because parent does not control this part. Okay, so this NCI will going to have certain share in profits of subsidiary company. Okay, and they will have 30% share of profits, right? But now see, we have to make adjustment for unrealized profit too. In our question, subsidiary company made sales to parent company, okay, which means that profit is lying with the subsidiary company. Okay, which company is holding the profit? Subsidiary company is holding the profit. Okay, so this unrealized profit would be distributed, we will divide it between parent company and NCI. Okay, so NCI will have 30% share of this unrealized profit, and we are going to deduct NCI's share by this unrealized profit. All right, so remember, whenever an upstream transaction is made where subsidiary sells goods to parent company, so subsidiary is holding the profit. Okay, since subsidiary is holding this unrealized profit, so we are going to divide it between parent company and NCI. Okay, so NCI has 30% share, so we are going to deduct complete NCI's share by the unrealized profit amount. So see over here, we are going to take NCI percent into subsidiaries profit after tax. So this is profit before tax, so ignore this. So we are going to take NCI percent, which is 30%, into subsidiaries profit after tax, and from that we are going to deduct NCI share of unrealized profit, which is this one. Okay, we will calculate this too. Let's see how we are going to calculate it. So over here, yeah. So the profit for year for the saucer is 130. Okay. So see, NCI's share would be 130 is 30%, right? So let's see how much it would be. This would be, wait a minute, I'll calculate it. 130 is 30%. This is 39. Okay. And how much was the unrealized profit? It was 5,000 if you remember. Okay. So NCI will have a share of 30% again in this. I won't take 5,000. I will just take 5 because I'm dealing in 3 zeros, right? Over here also I've eliminated the 3 zeros. So just take 5 over here. So 5's 30% is 1.5. Okay. So deduct 1.5 from here. So you will get the answer as 37.5. Right? Okay. Let's do the calculation in 3 zeros only. Wait. So NCI's share of profit would be the profit made by subsidiary company is 130 and take 3 zeros. So 130 and 3 zeros. Then take 30% of this. Okay. So this is 39,000. Right? Okay. Then from this deduct 30% of 5,000, which is 1,500. So your answer is 37,500. Okay. And over here in your NCI, just a second. Yeah, so this is your share of NCI, right? Let's move forward now. We were not given to calculate this. Okay, we just had to choose from here. We had to choose from these three items. But still, I told you how we will calculate it in case it comes in any other question. Okay. So let's see next question. Plate is considering the purchase of shareholding of another entity, and if purchased, this would meet the definition of associate. Okay. So whenever we make an investment which is an associate, how do we do the calculations? Okay. We do not consolidate. We do not add assets and liabilities. Okay. We do not do this. What do? We write investment in associate, okay, at whatever amount it is made. Suppose I made investment at $1,000, okay, I paid $1,000 to acquire an associate, okay, and I increase it by the profit share. Okay, whatever profit the associate company would make, I will take my share. Okay, suppose I own 30% of associate, so I will take 30%. All right, so I show all these things in my non-current asset column. Okay, so that's why I'm going to choose this. The net interest in associate is included as one line entry in non-current asset investment. Okay, so this is just one line adjustment where I take the investment and I increase it by the profit share. I add profit share to my investment made. Okay, we do not add all the assets and liabilities. Okay, so my answer is option number 3. Fine, let's move forward. Now, using individual financial statements, calculate operating profit for each entity. Okay, this is very easy and we have to make calculation to one decimal place. So let's calculate for both the companies using individual, which means using this information. So the formula for calculating operating profit margin is take operating profit, which is 408, and take the revenue. Okay, I'll write over here. So formula is operating profit upon revenue into 100, right? You just have to put the things in the formula. So 408 divided by 1500, 408 divided by 1500 into 100. So let's see what would be the answer. 408 divided by 1500 into 100. So it's coming out to be 27.2%, right? So similarly, you can do for saucer company as well. Let's see what would be the answer for saucer company. Take operating profit of 195 and revenue of 700. So 195 divided by 700 into 100. So this will come out to be, now see, it's coming out to be 27.857 and so on. But we have to tell up to first decimal place only. So see, over here at this place, hundredths place, this number is, if this number is 5 or greater than 5, then we add 1 over here. Okay, so since this is 5 or more than 5, I'm going to add 1 over here. So my answer would be 27.9. Okay, if in case this would have been 27.84. Okay, so this number is less than 5, so I would have written my answer as 27.8%. Okay, then I will not add 1 over here, right? So that's how we do rounding off. Let's move further. I guess we are left with only one requirement now. Yeah, we have to tell whether the answer is true or false. So the first they are asking is, operating profit margin will be affected by a change in value of closing inventory if all other factors remain unchanged. Okay, so let's understand this. So see, when we calculate our operating profit, how does it go? We first write revenue, and from that revenue, I deduct my cost of sales and I get gross profit figure, and then I deduct my indirect expenses and I get operating profit. Okay, that's how this works. Okay, now see, we have been told that a change in closing inventory, other things are remaining same, but my closing inventory changes. So see, if my closing inventory is changing, so my cost of sales would change. Okay, and obviously if my cost of sales are changing, it would have an impact over here. The formula for cost of sales is opening inventory plus purchases less closing inventory. Okay, so if in case my closing inventory would increase, so my cost of sales would decline. Okay, and if my cost of sales would decline, my overall operating profit would increase. Okay, and if in case my closing inventory declines, so my cost of sales would rise, and if my cost of sales would rise, so my operating profit would decline. Okay, so this statement is very true, because if value of closing inventory will change, then my operating profit will be affected. Okay, either it would increase or decrease. Let's see another part. The operating profit margin is not affected by interest and finance charge incurred during the accounting period. This is again true, because when we take operating profit over here, so the interest and finance charges are deducted after this. Okay, and we calculate our ratio using this operating profit and this revenue. All right, so this interest and finance does not has any impact on our operating profit. Our operating profit is, this is profit before interest and tax. Okay, and interest is our finance cost. So interest and tax does not have any impact on our operating profit. So that's why our operating profit margin will not be affected by interest and finance charge, right? So I hope this question is clear with you all. And still, if you have any doubt, you can ask in the comment section below. And if you found this video helpful, kindly like and subscribe. I'll meet you in the next video with another question. Thanks for watching. Bye-bye.